Let me ask you something right now. When your alarm goes off at 7 a.m., do you genuinely feel like getting out of bed? Or do you catch yourself thinking, I wish I didn't have to work today? Because the statistics reveal something striking. According to Gallup's 2024 Work Engagement Survey, 62% of Americans are not actively engaged in their jobs. In other words, nearly 2 out of every 3 people don't truly feel motivated when they wake up in the morning. Look, this has absolutely nothing to do with laziness or a character flaw. It reflects a very deep truth about exactly how the system works. Because we grew up in a system where we trade our time for money. You work, you get paid. You don't work, the money stops. It's that simple. But what if I told you this equation can be completely changed? That's what we're talking about today. What is a dividend? How does it work? And is it really possible to earn money while you sleep? We'll go beyond the theory. We'll cover real numbers, real companies, and concrete steps you can start today. If you're ready, let's dive in. What is a dividend? All right, let's start with the fundamental question. What is a dividend? I won't give you a technical definition. Think of it this way. Suppose a friend of yours opens a restaurant and says, "Come on board, take a 10% stake." Every month the restaurant turns a profit, your friend pays you 10% of that profit. That's the purest form of a dividend. You may never set foot in that restaurant or wash a single dish. The money still comes to you. The same logic applies in the stock market. When you buy shares of a company, you become a small co-owner of that business. When the company earns a profit, the board of directors may decide to distribute a portion of that profit to shareholders. That payment is a dividend. And in America, this system is deeply entrenched and well-established. More than 81% of companies in the S&P 500 index make regular dividend payments. Picture this. While you're asleep, scrolling through your screen or playing with your child at the park, that company is out there earning money on your behalf and sending it to you. Sounds almost too good, right? But now you might be thinking, if it's this great, why isn't everyone doing it? I'll answer that shortly. First, let's see how dividends actually work with real numbers. The dividend machine, numbers don't lie. Let's walk through a concrete example. Johnson & Johnson, ticker JNJ, pays approximately $4.96 per share in annual dividends as of 2025. That might sound modest, but do the math. If you own 1,000 shares of this company, you collect roughly $4,960 in dividend income per year. That's about $413 per month. Understanding where that number comes from is critical. J&J's dividend yield, the ratio of the annual dividend to the share price, hovers around 3%. What does that mean? If a share trades at $165 and pays $4.96 per year, that's roughly a 3% return. In an era of near-zero bank interest rates, that's a very compelling figure. But here's where the real magic begins. What most people fail to notice is this. J&J has increased its dividend every single year for 62 consecutive years. 62 years. That earns the company its status as a dividend king, meaning someone who invested in 1963 would today be receiving a return far beyond their original investment, a source of income that essentially protects itself against inflation. And J&J isn't alone. Procter & Gamble has raised its dividend for 68 years. Coca-Cola's streak stands at 62 years. 3M has kept the streak alive for 65 years. Look, these aren't random companies. World wars, economic crashes, pandemics, they kept paying their shareholders through all of it. That alone is extraordinary. Compound interest plus dividends equals real wealth. Now we get to the truly magical part. If you take your dividends and spend them, you've created a nice supplemental income. But if you reinvest those dividends, put that money right back into the same stock or other shares, that's where the magic of compound interest kicks in. I'm talking about what Einstein reportedly called the eighth wonder of the world. Here's a concrete example. Say you're 30 years old and investing $500 a month. You're targeting an average annual return of 7%, actually below the historical average of the S&P 500. By the time you retire at 65, 35 years later, your portfolio has grown to roughly $935,000. Of that, only about $210,000 is money you actually put in. The other $725,000 was generated by your money itself. That's compound interest. Now combine that with dividend investing. When you reinvest your dividend income, your portfolio grows faster. Why? Because you're buying more shares. Those shares produce more dividends, those dividends buy more shares, and the cycle spins on its own. This is called the snowball effect. A small snowball rolling downhill keeps getting bigger. Money works the exact same way. Now, you might be thinking, that's all well and good, but I'm not 30 or I don't have $500 a month. I hear that objection, but here's what I'll say. Time is worth more than money. Starting at 50 with $200 is far better than starting at 60 with $5,000, because you can never buy time back.
Types of dividends. They're not all the same. There's more than one way to earn dividend income. Each path carries a different risk profile, different return potential, and different tax treatment. Let's quickly break them down. The first path is individual stocks, investing directly in a single company. Take Realty Income, a REIT that actually pays dividends monthly, not annually. As of 2025, it pays roughly 26 cents per share per month, with a dividend yield ranging between 5 and 6%. It's quite attractive for investors seeking steady income. The second path is dividend ETFs, exchange-traded funds. Think of an ETF as a basket holding dozens or even hundreds of companies at once. For example, SCHD, the Schwab U.S. Dividend Equity ETF, was offering a dividend yield of roughly 3.5% to 4% as of 2025. It dramatically reduces the concentration risk of holding a single company, ideal for portfolio diversification. The third path is REITs, real estate investment trusts. By law, REITs must distribute at least 90% of their taxable income to shareholders to maintain their tax-advantaged status. As a result, their dividend yields tend to be higher than most other sectors. But high yield isn't always good news. I'll explain that in a moment. The fourth path is preferred stocks, hybrid instruments that blend the features of both bonds and equities. They pay fixed or variable dividends, and in the event of bankruptcy, their holders are paid before common shareholders, a favored choice for more conservative investors. The dangerous trap: high yield isn't always good. I want to stop here and warn you, because this is exactly where many new investors go wrong. When you see a 15 or 20% dividend yield, your eyes light up. A company paying that much must be amazing, you think. But the opposite may very well be true. Here's the reality. If a company's dividend yield suddenly spikes, there are two possible reasons. Either it raised its dividend, that's good, or its stock price collapsed, that's bad. And when the second scenario is at play, it usually signals serious trouble in the company's financial health. This trap is known as a dividend yield trap. To gauge this, we look at what's called the payout ratio, the percentage of a company's earnings paid out as dividends. If that ratio exceeds 100%, the company is paying out more than it earns. That's unsustainable long-term. Historically, a payout ratio between 40 and 60% is considered a healthy signal. There's also the matter of a dividend cut, when a company reduces or eliminates its dividend payment altogether. During the COVID-19 pandemic in 2020, many major corporations were forced to cut their dividends: Exxon, Boeing, Ford. These moments drive home just how critical it is to choose the right companies. So when investing in dividends, don't just ask about the yield, ask whether that yield is sustainable. Dividend aristocrats and kings, the elite club. I want to tell you about a very exclusive group.
They're called Dividend Aristocrats. To qualify for this club, a company must be a member of the S&P 500 and must have increased its dividend every year for at least 25 consecutive years. As of 2025, approximately 66 companies belong to this club. A few examples: Colgate-Palmolive, 61 consecutive years of increases; Emerson Electric, 67 years; Genuine Parts Company, 68 years of unbroken growth. Think about it. Someone who invested in that last company in 1957 is still receiving increasing dividend payments today. The Cold War, stagflation, the dot-com bubble, the 2008 financial crisis, the COVID pandemic, they weathered all of it. One tier above is the Dividend Kings. The criterion there is 50 years of consecutive increases. As of 2025, roughly 54 companies have earned that title, including household names like Coca-Cola, PepsiCo, Cisco, and Walmart. Investing in these companies isn't a guarantee, of course, but it does mean building on a foundation of extraordinarily strong historical performance. Now, you might be wondering, okay, these companies are impressive, but how do I actually analyze them? Where do I start? I'll walk through that shortly. But first, I want to talk about the psychology of money, because knowing the best strategy is a very different thing from actually following through on it. The psychology of money: why most people fail. Here's the truth. Dividend investing is technically simple, but psychologically, it's extremely hard, because we humans are wired for instant gratification. The brain prefers $100 today over $500 5 years from now. Behavioral economists call this hyperbolic discounting. That's not abstract. Let me make it tangible. During the 2008 crisis, the S&P 500 fell roughly 57%. Even dividend aristocrats lost value in that environment. Many people panicked and sold. Yet investors who held their positions and kept reinvesting their dividends had, by 2013, not only recovered their losses, but come ahead. That kind of patience is worth more than any amount of knowledge. So how do you escape this psychological trap? Path 1, automate your investing. Set it up so that on the day your paycheck hits your account, a fixed amount automatically flows into your investments. No decision, no second guessing, the system just runs. Most Americans do this through their 401k plans. As of 2025, the annual contribution limit for an individual 401k is $23,500. For those 50 or older, it's $31,000. Path 2, treat downturns as opportunities. This is hard because emotions take over, but as Warren Buffett put it, the market transfers wealth from the impatient to the patient. In dividend investing, a falling price means you can buy more shares with the same money, which means more dividends in the future. Path 3, anchor yourself to a why. Don't invest just to be wealthy in some abstract sense. Invest for something specific. I don't want to be working at 60. I want to cover my child's college tuition. I want to work 3 days a week. These become the anchors that keep you steady through the rough patches. Tax advantages. Now let's talk about something very few people discuss, yet it's absolutely critical: tax advantages. In America, where you hold your dividend-generating investments directly determines how much tax you pay, and that difference, compounded over decades, can be enormous. First, let's look at the Roth IRA, a tax-advantaged account. As of 2025, the maximum annual contribution to a Roth IRA is $7,000. For those 50 or older, it's $8,000. The biggest advantage: all gains inside the account, including decades of accumulated dividend income, are completely tax-free in retirement. Not a single cent goes to the government. The traditional IRA works differently. It gives you a tax break today. The money you put in may be tax-deductible, but you pay taxes when you withdraw. Which is better? It depends on your current versus your expected retirement tax bracket. The general rule of thumb: if you're young and in a lower income bracket, Roth IRA. If you're in a higher bracket now, traditional IRA may be more advantageous. There's also the matter of qualified dividends. In the US, dividend income is taxed in 2 tiers:
Qualified dividends, those meeting specific criteria, are subject to the lower long-term capital gains rates, 0, 15, or 20%, depending on income. Ordinary dividends are taxed at standard income tax rates. As of 2025, the vast majority of dividends paid by the S&P 500 companies qualify as qualified dividends. That's a very meaningful tax advantage.
A real-life scenario, how the numbers play out. I want to draw you a real scenario. I won't name names, but it clearly illustrates the true potential of dividend investing. Imagine someone who's 35 years old, middle income, living in Chicago. After rent, utilities, groceries, and all the rest, they have $600 left over each month to invest. This person invests $600 every month into a dividend ETF like SCHD. Let's assume an average annual total return of 8%, a blend of dividend income and price appreciation. 30 years later, at age 65, the portfolio has grown to roughly $815,000. About $216,000 of that is money they actually put in. The remaining $599,000 is pure compound growth. But here's the truly magical part. That $815,000 portfolio at a 4% dividend yield generates about $32,600 in income per year, roughly $2,700 per month. This person no longer has to work full-time. They can choose to work, but they don't have to. Think about what it means to have unconditional income. That is financial freedom. And keep in mind, this calculation is built on conservative assumptions. If they reinvest dividends during the growth phase instead of spending them, or allocate toward higher yielding positions, the numbers get dramatically larger. What most people miss is this. This strategy doesn't require becoming a millionaire first. It only requires being systematic, patient, and intentional. Where to start? A step-by-step investment guide. All right, now we get to the practical part. Theory is worthless without action. I'm going to give you 5 concrete steps. Nothing overly technical, realistic, and actionable. Step 1. Build an emergency fund. Before you invest a single dollar, accumulate a liquid emergency fund covering at least 3 to 6 months of expenses. Why? Because if an emergency forces you to liquidate your investments, you interrupt compound growth. Keep this fund in a high-yield savings account. Institutions like Marcus by Goldman Sachs or Ally Bank were offering 4 to 5% annually as of 2025. Step 2. Open a brokerage account. Consider well-established institutions like Fidelity, Charles Schwab, or Vanguard, all offering commission-free trading. Opening a Roth IRA takes only a few minutes and is entirely online. If your employer offers a 401k with matching contributions, prioritize that first. Employer matching is free money. Step 3. Build your portfolio. For beginners, it's smarter to start with dividend ETFs rather than picking individual stocks. SCHD, VYM, Vanguard High Dividend Yield ETF, and DGRO, iShares Core Dividend Growth ETF, are frequently considered in this space. These 3 ETFs together form a diversified dividend portfolio spanning hundreds of companies. Step 4. Enroll in a DRIP, a dividend reinvestment plan. This automatically uses incoming dividends to purchase additional shares, available free of charge at most brokerages and activatable with a single click. With this running, compound growth shifts to autopilot. Step 5. Monitor, don't panic. Accept in advance that your portfolio's value will fall at times. This is a normal part of the system. What matters is maintaining regular contributions and reinvesting dividends. Review your portfolio seriously once or twice a year, not daily. Overtrading kills performance. The most common mistakes. Let's talk about the traps most people fall into. Knowing these mistakes makes them much easier to avoid. Mistake 1. Fixating on high yield alone. I've touched on this. When you see a 15 or 20% yield, stop and ask why. Look at the company's financials. Where is the payout ratio? What does the debt load look like? Is revenue growing or shrinking? Mistake 2.
neglecting diversification. Concentrating in a single sector or a single stock unnecessarily amplifies risk. Energy, financials, consumer staples, healthcare, dividend-paying stocks exist across all these sectors. A spread-out portfolio protects you when any one company or sector stumbles. Mistake 3. Ignoring inflation. If your portfolio yields 2%, but inflation is running at 3%, you're actually losing purchasing power. So dividend growth should be evaluated not just in absolute terms, but as real growth relative to inflation. Historically, dividend aristocrats have consistently grown their dividends above the rate of inflation. Mistake 4. Impatience. This is perhaps the most dangerous of all. Dividend investing is a slow game. In year 1, you might collect $20 or $30 in dividends a month. Is this really worth the effort, you might wonder? But look at year 10. Compound growth makes those early-stage numbers unrecognizable. Momentum builds from year 5, becomes striking by year 10, and by year 20, it's breathtaking.
2025-2026 market conditions, where do we stand? Let's put this in current context. Heading into 2025, the Federal Reserve continued its gradual normalization of interest rates. The Fed funds rate stood near 5.5% at the end of 2024, and incremental rate cuts were carried out throughout 2025. This matters enormously for dividend stocks. When interest rates are high, safe government bonds also offer attractive yields. So investors ask themselves, why take on risk when bonds are paying well enough? But as rates fall, the relative appeal of dividend stocks rises. In the 2025-2026 window, the expectation is that investor demand for dividend stocks will increase as rate normalization continues. Inflation remains a concern. The Fed is working towards its 2% target, but that journey takes time. Dividend growth stocks that outpace inflation serve as a strong portfolio hedge during this period. History is clear. Even through stagflation, companies like Coca-Cola and P&G kept paying their dividends. The AI and tech sector tells a different story. Most of these companies pay no dividends or very modest ones. They're reinvesting profits into growth. But a noteworthy trend is emerging. Tech giants like Microsoft, Apple, and Meta have started paying dividends or have been raising them. The intersection of the technology sector and dividend investing is one of the most compelling storylines of the 2025-2026 period. The financial freedom ladder. Which rung are you on? I want you to think of financial freedom as a ladder. Each rung builds on the one below. Rung 1 is financial security. You have an emergency fund, you're managing your debts, and your basic needs are covered. Rung 2 is financial stability. You've paid down some debt, you're saving consistently, and you've made small but real investment moves. Rung 3 is financial flexibility. Your portfolio now generates modest but meaningful dividend income, and you can absorb a major unexpected expense without derailing the system. Rung 4 is financial independence. Your passive income covers your core living expenses. Work becomes a choice, not an obligation. Rung 5, the top of the ladder, is financial freedom. Your passive income funds not just your needs, but the lifestyle you actually want. Let me be honest with you. Most people are aiming for Rung 4, and that is an entirely realistic goal. Rung 5 is like perfection, beautiful, but not mandatory for everyone. Simply being on Rung 4, having the option to say, I'm working because I choose to, is a transformation that changes the quality of your life in ways that go beyond money. Take action today. While watching this video, you might have thought, yeah, I get it, but I'm not quite ready yet. Or maybe, this isn't for me, it's too complicated. Let me be very direct with you. There is no perfect moment. The market always looks a bit risky. The portfolio always seems like it should be bigger first. Tax laws always seem like they could stand to be a bit clearer. But here's what most people fail to see. Staying still is a decision too, and it's often the most expensive one.
Every year that passes is another year compound interest could have been working for you. If you're 30 in 2025 and haven't started, every year you wait to 2026 is another year of compounding you forfeited. Time is the most valuable resource, and you cannot buy it back. Here are 3 concrete assignments for you. First, this weekend, set aside 30 minutes and open a brokerage account, Fidelity, Schwab, or Vanguard. It's completely free. Second, make your first investment. The amount doesn't matter. $50, $100, $500, what matters is starting the engine. Third, set up an automatic contribution. Every month, on a fixed date, a fixed amount automatically leaves your account and goes into your investments. Then forget about it. Financial freedom doesn't arrive in a single day, but every right step moves you closer to it. Dividend investing isn't really about earning money in your sleep, it's about making conscious, informed decisions while you're wide awake so that money can work for you, and that is something every single person can do. If this video was useful to you, share it with a friend, because financial literacy isn't a privilege, it's a right.
Don't forget to subscribe and turn on notifications. See you in the next video. Take care of yourselves.